Hey everyone, this is Jose. This is a sound check. Before we start the session, we're starting in around 20 seconds. Please go ahead in the chat box and just have a quick yes to confirm that you hear my voice, and that way I know we are ready to start. Okay, wonderful. I see Bojan, Eric, how are you, my friends? Very good. We just got to the top of the hour. Hi, Lisa. Wonderful to see you all. Okay. Well, if you were to be in Asia, today is the second time that we are getting together. Yesterday we had an amazing special session with Bojan. How are you, Bojan? And, of course, if you're in the US time, that was yesterday. But again, depending on where you are in the world, if you were in Asia, is our second session today. Okay, so let's keep going, guys, with the sessions. Let's keep going with identifying market opportunities and developing ourselves as traders. Okay, let's begin the session. Special day talking about Asia. If you are into Asian culture, Chinese culture to be more precise, today is 8th of August, 88. Lucky number, isn't it? So let's have a great and lucky session. My name is Jose Blasco. I'll be your guide. Today is Thursday, so we're getting together for longer term purposes. We'll be dealing with options, looking for swing trades or beyond, depending on what the market brings us. And before we start, as always, we have a disclaimer. The following videos, clips, demonstrations are for educational and instructional purposes only. Traditive provide these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And this takes us to the end of the introduction slide for today's session. Okay, so we are ready now to put some trades in place to identify some market opportunities. As always, I have a trade station. I am pointing with the blue arrow to the scanner. Within the scanner, we have directional trades on the top, non-directional trades on the bottom, pure non-directional here in the middle, okay? And the ones below would be what we call neutral trades, okay? So neutral below, pure non-directionals in the middle, and directionals on the top. And the idea is to go over those different set of opportunities to find what is best and be able to plan those trades, check if they meet our rules, and if they do, go ahead and execute those trades, exposing ourselves to market risk with odds in our favor while we manage our risk, and most importantly, we manage our mindsets, okay? We talked a lot about that earlier in the day here in Asia, or yesterday in the evening in US time with Bojan. Again, amazing session. If you haven't seen it, I recommend you intensively to get into our YouTube channel and go ahead and look into the playlists, get together playlist, and find the session name as Special Trading Psychology. Okay, it's the one on top of the list, so you can find it easily. Okay. Anyway, so let's begin the day. We'll start with non-directional trades. Today we have a few opportunities here. As always, for example, we have Boeing, CVNA, IYR. That is an ETF. Okay, that's an ETF. So normally for non-directional trades, we pass on the ETFs because there is always less premium built in. There are certain instruments that experience basically will teach you what they are. Okay, we need to know the products that we trade. So ETFs typically have less premium built in. Verizon, even though it's not an ETF, it's also a stock which normally we find extremely little amount of premium. So again, with non-directional trades, is normally not too useful in the sense that for non-directional trades, you need to collect great amount of premium because that's how you get paid. Okay, and those stocks normally are pretty quiet. Okay, and Verizon is normally very quiet and doesn't provide two great levels of premium. And XLU as well is also an ETF. Okay, so we will pass on that one too. Okay, so we'll be looking at those different stocks from the list, looking for planning those trades. But while we are doing that, in parallel, we also need to bring a tool to be able to check on the earnings dates earnings reports, because the reason why those options may be overpriced, identified by the scanner as overpriced, the reason may be that earnings is around the corner. And if that's the case, we need to be sensitive to this, because we may not be able to execute the trade if that's the case. Okay, so we need to make sure that's the case. Okay, so we're gonna start, since I clicked on UNH, let's begin with UNH to see what is the earnings date, and this will set what we have in front of us. Okay, so notice how UNH reported earnings in July. Next time earnings will be reported is in October. Okay, so there is no earnings anywhere close by, but with all that said, UNH is being selected by the scanner as a stock that meets our criteria. Okay, criteria when it comes to this market not being clearly in a trending mode. And also this market providing a high level of premium for the options. Okay, so that's a good beginning. Now, when looking at the AutoUFOs, okay, we have a little bit of a bad news here, which is that when looking at a regular session, which is the session I have active at the moment, we got a metric of probability which is 46.5. And this is not a very good news, because that means that many times those large market players that insert those orders in the market, they tend to cancel them. Okay, and therefore we need to go ahead and check pre and post market to see if we get a better measurement, and we do with 47.75. That's a better measurement. Okay, ideally we want to be above 50. That's the minimum we require. We know stocks will never have a very high value in this probability scenario, because stocks are fragile. We said that a million times in the session, and fragile means that they depend on different external factors such as the sector, the S&P, etc. And the figures you will get with stocks are never going to be as the figures that you get with futures or forex, which is normally going to be into the 60s or sometime even the 70s. With stocks, you're going to be always around, let's call it 50s. But 47 is below that, so not comfortable with this trade. You have seen me at times, only in cases of non-directional trades, you have seen me at times still going ahead and executing a trade. And, we could certainly come back to UNH and take a look in case UNH was to provide an extreme amount of premium where we could sell options very far out, and still get paid enough, then could be worth it to still take the risk, because you would have a ton of time decay working for you. But having a beginning part of the trade with a low UFO performance stat figure, it's not ideal. Okay, since we have more stocks in the list, then I'm gonna move to BA, for example, Boeing, okay, and see what's going on with Boeing, to see if we have a scenario as well where earnings are not anywhere close, and therefore we can set up a similar type of trade with better probabilities. Okay, so with Boeing, the last earnings took place on 24th of July, so that's a couple of weeks or so ago, and the next one will take place in October 23rd. So there is no risk in front of us, and still the premium that we find in Boeing is still significant. Okay, so that's interesting. Okay, that's useful, and that certainly can be helpful. Okay, on top of that, now with Boeing, we got 52% UFO performance stats if we apply AutoUFOs to pre and post market. If we apply it to regular session, instead of 52, we get 48. So notice how the app is identifying that the way the large market players that trade Boeing, the way they are placing and potentially canceling their orders is done in a way where there is more cancellation of orders during regular market hours compared to pre and post market. Okay, so therefore we are better off at using pre and post market data to plan this trade. Now the problem is that, and I can probably see this better in a daily time frame. Okay, the problem is that Boeing has been falling, and the last time that we got price below, it's more or less around January earlier this year. So that's like 8 months ago, 7 to 8 months ago. And when we are looking at the 55-minute time frame, where the way I have my TradeStation set up, that by default is loading 1,597 bars. Well, the problem is that this is not an amount great enough to get me all the way to January. So I will need to add more bars to see if I can get market data all the way to January. and therefore potentially encounter if there is any green UFO below price. Okay, so notice how 2000 bars is bringing me to February. I scrolled all the way to the left on the chart, which means that again I need to find just a few more bars. So I'll add, let's say, 3000 bars, and this should bring me data. Here we go, data below, and now we can see the UFOs available. Okay, because by loading 3000 bars, well, now I just got a chart going all the way to October last year. Okay, which we don't need to go that far. Okay, the data that we need, is good enough. Using those January UFOs that we can see here around 316. Okay, so we have a setup. Okay, and I'm just gonna draw a few lines below those UFOs. So that's UFO number 1. This is UFO number 2. We'll go for UFO number 3 as well. Okay, so I'll just put those lines in place because that way I know where the extreme of those UFOs are. Okay, because the ones on top, it doesn't matter. I don't need to load too many bars. I have them here. The ones below, I have to load many bars, and therefore, I could certainly now reload this chart with less bars, and I would still know 314, 309, 302, and 292 are the extreme values of those UFOs. Okay, so I'm just placing my lines here out of convenience. Okay, so knowing that we may have a setup which is valid with Boeing, the idea now would be to use probability and statistics, okay, to tell us from now until whatever expiration date we choose for this trade, how far is that stock likely to move. And based on that, we will be able to plan a trade, more than planning a trade, we will be able to select the right UFO for that trade, okay, and take advantage of the opportunity as long as the premium collected around those UFO values are enough. Okay, let me show you this more than using words, because if you are not used to the process the way I just described it, may be a little confusing, even though what I said is correct, but it will probably only click if you are used to the process. Okay, so some of you may be newer than others in our community, in our group, and therefore I want to show you that properly. Okay, so I'm going to start with August 16. This is 8 days from now, and what I'm going to do without even thinking is I'm just going to right click anywhere to analyze and sell an iron condor. And again, of course, I will need to be more specific later on how I'm going to position that iron condor. But right now, the only reason why I did that is so automatically on the analysis tab, I got the iron condor show up, as you can see. Okay, and this allows me to do something very simple, which is on the upper part, I can go ahead and change this to +1 standard deviation, and below I can move it to -1 standard deviation. Okay, this is telling me that from now until August 16, Boeing is likely to move anywhere between 349 to 316. That's based on stats. This is not using UFO data. Okay, this is not working in tandem with AutoUFOs. This is just a pure mathematical statistical calculation, which is good to make us more objective. Okay, you would never want to trade only pure on stats. You want to align yourself with where the on-field orders are, but it's a good beginning to have an objective measurement that tells you that from now until August 16, there is a possibility for Boeing to reach 349, but if it gets there, okay, you would not be wrong to say that that market has been stretching itself quite a lot to get to that price from now until August 16. So in other words, it's not too likely that you would get to 349. Okay, and if you look at the chart, okay, and we were to draw a line here, this line falls in at 348. So in other words, from now until August 16, we may surpass this UFO just by a little bit. It's kind of unfortunate that the UFO is pointing at 348. It would be so great to have a UFO around 350, something like that, because then you would be able to say, okay, price is not likely to go above the UFO because it's a UFO. And on top of that, statistics suggest that price is not likely to surpass that number either. So it's kind of like you got two ways to look at the trade, and both are confirming the same information, which is that price is likely to stay below 349. Okay, but unfortunately the UFO is not 349, it's 348. So the only way to be able to plan on this trade would be to go for the next one, okay, located here at 373. Now 373, I mean, if you are not likely to go above 349, you are even less likely to go to 373. And if that's the case, so probably we are not the only ones that know that. So if I was to look at the option chain, well, even without getting to the 370 something, notice how I am being paid 11 cents, which is not enough. So in other words, because the range I'm going to be planning on for this iron condor is a wide range, I may need to use a further expiration date where I do get enough premium for the 372.5, which is around 373. And notice how this one, 23 cents, is almost meeting our rules. Just in case you don't remember the rules, when we are selling options, we are always shooting for those 35 cents. In certain cases, it could be justified to go to 25, but in this case, we got 23, which, it's not 25, is not 35 either. So in other words, because the range is so wide, okay, we will need to probably use August 30. And if we do that, the 372.5 is now paying 50 cents, which is certainly more than 35. Okay, and now we have something to work with. But before we get too excited, okay, knowing that now we are looking at August 30 date, we're going to have to go back to analysis and change the iron condor to August 30 to find out what value is the new value that we are given, which is 359. Okay, so now, because we are giving the trade more time, instead of August 16, we are adding 15 more days all the way to the end of the month of August. So now, that statistically speaking, produces a situation where if Boeing was to continue moving at the same speed it's been moving in the past, so we may get to 359. And 359 is also below 373. So that is nice. Okay, that is nice, okay, because, this is suggesting that this trade may certainly be, correct and meet our rules, okay? Now, on the bottom side, so on the top side, we're going to use 373, okay? Even though the calculation suggests 359, which is here, we're not going to use 359 because around 359, at this level, we don't have a red UFO. The UFO is above, and therefore, we're going to have to use 373 as the value for the upper part of our iron condor range. When it comes to the bottom part, statistics suggest 307. Okay, so 307 is located below 309, so 302 would be a valid value for us to use. Okay, so I'm gonna go ahead and make this thin, so we kind of remember, or visually it is clear that we have some UFOs there, but really the UFOs that matter to us is the 373 and the 302 or below. And now to make this a little more advantageous, and Lisa, I can see you have a question. I'm coming back to you right now. So to make this a little more advantageous, what I would also want to do is to measure the vertical distance. Okay, measure the vertical distance from the current price to the extreme place of the upper UFO and project this to the downside. Okay, and if I was to project this to the downside, notice that if I was to select the 292 UFO, it's kind of like the current price is more or less at an equal distance between 373 and 292. Okay, and that would potentially produce an opportunity that is valid for us. Certainly, it puts you at a better advantage if you want to be purely non-directional, which is the filter that we have selected, or because we're running that scan here. It would put you at a better advantage, okay, to, instead of focusing on the 302, to focus on the 292. So current price and hitting the upper or the bottom line would be more or less equal distance. Okay, so you're giving yourself an opportunity where you may stay greater amount of time between the lines. Okay, and greater amount of time in trading options means collection of a greater amount of time decay. Okay, so very quick. So how much I will get paid if I sell the 292s? So we don't have 292, but we have the 290. And if you were to sell the 290, you get paid 136, which 136 is more than the 25 or 35 cents that we talked about. Okay, so anyway, it's looking like indeed Boeing may give us a non-directional opportunity. I will stop the planning of this trade here because 1 minute from now the option chain will reset It's 10 minutes before the market opens, and really we want to plan this trade with real-time values. It would make the trade to be more closer to reality. I mean, if you had planned this trade yesterday in the evening, it's still fine. And if I was to plan it now, it's still fine as well, because it's the same values as yesterday in the evening, US time, when the US market closed. But since the market is about to open, so instead of planning it with the current values, I'll wait until the market open, come back to buying, knowing that we're going to be using 292 and 373, and we will try to build an around condor and see if it works at that moment in time. Okay, so Boeing, we just made a note for ourselves. So Lisa, Jose, I noticed that Option Station Pro uses close of the prior day, not current overnight trading dollar. Do you take that in consideration? Okay, it's fine, Lisa, because when you do non-directional trades, the reason why we are using Option Station Pro to perform that initial calculation with standard deviations and so on, all of this, it's for us to have a feel of how far the UFOs we're going to use need to be. And when I say have a feel, is to have a feel not like a human being feels, but like a mathematical calculation feels. Is that making sense? So, as long as you are consistent and you are always using either the current close or the prior close, because different platforms may work differently, then you're going to be okay, because the process that you apply every time when you do the trades is the same. And we don't need to be super precise, because in the end, being right or wrong on the trade will not be because of a mathematical calculation that either uses the current close or the prior close. Being right or wrong on the trade is much more likely going to be because of the UFOs you are selected, okay? And therefore, this is just, for example, I could have planned this trade with the 346, okay? But what are the chances of getting to 346 from now until August 30? The chances are too great. So could the trade work? Yes, but what's the probability of the trade working? Much less. Okay? Is it because that UFO is wrong? No, it's because that UFO is too close. Okay? So that's why we are running the process this way. And if you were to change a little bit of how the calculation is done, it's fine. Okay, it's not a big deal, Lisa. Okay, good question, and I love how detail oriented you guys are, because this in the end translates in rules. Okay, so I love these questions because it tells me that what you're doing in your trading is right. Okay, so thanks for that. Anyway, so let's continue. Okay, let's go back to the next trade. The next trade we may have available here, we'll look at Merck. Okay, so let's load Merck in briefing.com to see MRK, to see if the earnings date is close or not. So July 30, that was like a week and something ago. This is when the earnings were reported. October 29, so similar setup again. Looking good. Let's take a look at Merck. So probability is 42% using pre and post market. That's not looking good. What about regular session? We got 55%. So that is looking good. Okay, that is looking good. So we got good levels of premium in those options based on what the scanner has identified, and we got a collection of UFOs above and a collection of UFOs below. So I would say it should be relatively simple to be able to put together a non-directional trade on Merck as well. Okay, so we may have two trades available today, of course, as long as we have premium enough. So remember, first thing you do, you just type the symbol, you go into the option chain, you don't even think about it, uncover the next expiration date. I got many strikes here, so I'm just gonna make the list shorter just so it's easier on our eyes. And no matter where you click, you just right click, select, analyze, sell, and iron condor. And again, the reason why we do this is just so we have one standard deviation, minus one standard deviation, so we know what to expect from Merck from now until August 16. And what to expect is to move around 87.66, which 87.66 is above those UFOs. Okay, it's above those UFOs, and I believe, let me see, daily time frame, yeah, weekly time frame, yes. So my memory is right, unfortunately. Well, actually, we do have some market data located right here. This is January 31st, 01. Okay, so we may have some UFOs left right here, some unfilled orders left, or some traces of potential UFOs. Now we need to go back, what did they say, all the way to, wow, December, this is, yeah, October 2000, okay, so Let me do this way. So October 1st, 2000. So that's 19 years of data. Okay. I'm not sure we don't have time to. Oh, sorry. I needed to do that with a 55-minute time frame. So 19 years of data is gonna take a real long time to load. Let me see. Data. Edit symbol. Okay. Oh, yes. I just picked the wrong date. I picked the last date to be 2000, where I should have picked the first date. October 1st, 2000. Okay, that makes sense now. So the download will begin now. It's gonna take a long time. Okay, so I'll leave it alone, running in the background. This is gonna be a little tricky later on, because if we run AutoUFOs with 19 years of data on a 55-minute time frame, is likely going to freeze our TradeStation. Okay, so we're gonna have to do this in a way that is disconnected from the network. So I will show you how to do that later on. Okay, but for now we are just downloading the data. Okay, TradeStation has the download scheduler here. So let me show you how, when I click download scheduler, we got this window, and it's, as you can see, the range selected is from October 1st, 2000 to August 6, 2018. Okay, because all the way to 19 we have already downloaded the data, so the download scheduler knows that the data is in our cache folder on the hard drive. Okay, so we leave this running in the background, and I will want to look at KSS. Okay, the liquidity of options of KSS is not the best. Just like Roku, it's not the best. That's why I left them for the end. So August 20. Okay, August 20 is the expiration date that we have with KSS. This allows us to use August 16, isn't it? So I'm gonna move to the 55-minute time frame. I'm gonna go ahead and look at KSS. So just like what we did before, as the option chain loads, everything is gonna be zeroed out. Okay. Oh, funnily enough, it's not. So we're gonna right-click to analyze and sell an iron condor, and again, I'm just gonna go ahead and, as done before, select +1, select -1 standard deviation. Okay, yeah, and it's zeroed out because you can see it's giving me the same values everywhere, 51.21. Okay, so we're gonna have to wait 2.5 minutes for the market to open and be able to plan the trade with KSS. Okay, so we'll do that as the market opens. Okay. Yes, I just got a couple of messages from TradeStation here. Good. So. Yes, Lisa, and your observation is correct. Okay, but again, it doesn't have a major impact in what we are doing when we are applying this. Okay, so anyway, so KSS, we got 46% probability when using regular session. If we use pre-post market, we got 43. So unfortunately, the way large market players are dealing with KSS, when those fund managers and so on, they place orders. If they don't get filled, they cancel the orders. Hence, such a low value. Okay, so just like the case with UNH at the beginning of the session, we will pass on this one, and therefore I would like to check Roku. Okay, to see if Roku give us an opportunity for non-directional trading. The last one we had earnings report was August 7. Today is August 8. Okay, so we will pass on this. Okay, we will pass on this. I want to do one last confirmation as the market opens in no time. I will activate implied volatility. The implied volatility, which is being used in the scanner, measures how pricey those options are. You can see those options are overpriced. Okay, so pointing at 84. Okay, so initially you would say, well, that's great. Okay, but the problem is that this value with TradeStation is updated after the market closes only, and therefore the scanner is using yesterday data, which today's data may be much lower than that. Okay, so I want to show you how you can find out the real-time data to either confirm that this trade is still valid to be executed, or we're gonna pass. My feel is that, as it happens most of the times, when the earnings took place on the last day or before the market opens, most of the times we will see that this will not be a valid value. Okay, but we need to wait for the market to open. Notice that the values yesterday when the market closed were 294, 135, 103, 92, 85. If you were to kind of do the average of all of these, you get 84. Okay, so in other words, when the market closed yesterday, everything was quite spicy. Okay, so good one for us to plan on selling options. Okay, but the market is going to open now in 10 seconds. And as the market opens, okay, in 10 seconds, all those values will begin updating. Okay, so the market is about to open. So 1, 2, and 3. Okay, here we go. So the market just opened, and look at what happened to the values. It dropped all the way to 76, 69, 68, 77. You know, there is a drop. Okay, there is a drop. Now, I have to say that 77 is somewhere here. So, you know, I want to watch the option chain a little closer, because even though we did have a drop, okay, because earnings already took place, it seems that the drop is not too much, okay, and with this massive moving price, 18% up for that stock, you know, the amount of, value built in those options is still very, very high. So we may have an opportunity, okay, but for me to have an opportunity, I need to find UFOs. And unfortunately, that stock is making all-time high. It's a pretty new stock, as you can see. It was born in September 2017, and that stock is making all-time high. And therefore, again, unfortunately, we don't have red UFOs above. We only have green UFOs below, and therefore, we cannot plan on a non-directional trade. By the way, with an 19% move now, as we speak, obviously that stock is now has completely changed the climate. Okay, has completely changed the climate. Went from red to major blue. So now this is a very majorly moving stock. This is not a stock you want to use for non-directional trading. Okay, so we tried, we give it an opportunity. Okay, but in this case it was not valid. Okay, so let's go back to Boeing. Okay, because the plan was when the session begins, let's go ahead and let's recheck if we have an opportunity with Boeing or not. We said that using the 55-minute time frame, we were going to plan trades on Boeing, leaning against those thicker purple lines on the chart. So I am reloading. Yes, I believe I may be making an important mistake here. Well, not really a mistake, but I may be slowing myself down big time. No, I'm not. Okay, so I'm just loading. If I do 55, yes, I'm just loading the amount of bars. Okay, good. So the reason why then it was not loading probably is because we still have the download scheduler downloading. Oh no, it finished already. Okay, so it's good. I guess it just finished. Good. So we have, remember we launched a lot of download for Merck. Okay, so my concern was that. Okay, so this is the 55-minute time frame. We concluded that we are expecting Boeing to stay between 373 and 292, and therefore it is now time to go back to the option chain, reload BA for Boeing, and go ahead and see if we could have a proper trade running on Boeing using August 30 expiration. That's the one we said we were going to use. Okay, so let me load more strikes, because the idea would be to sell options above 373. So 373 as an iron condor, and I quickly remind you that iron condor is made of buying a call and selling a call above, and selling a put and buying a put below. Okay, that's how you do an iron condor. Because we got 373, so 372.5 would do. Okay, it's the nearest value, and if I am not mistaken, that option was available on the option chain 372.5, and this one is paying us 52 cents, little more than what we saw before. So that's okay, that's valid. Okay, we have more than 35, which is the minimum we need based on the rules we discussed earlier. The next strike is 375. So then I'll just write it here, even though I know I'm going to have to adjust that. You will see why in a minute, because now below we would want, ideally, okay, in a perfect world, what you would want to find is 292.5. But if I'm not mistaken, that option was not available, the 292.5 put. We had 295 and 290. okay? But we don't have the 292.5. Even if I load all the strikes, actually, funnily enough, we don't have anything below 290 either, okay? So that's a problem, okay? We have a problem. We have a problem here, and this may push us to use September 6th. And September 6th is providing the same exact situation. We don't have anything below 290, guys, interestingly enough. So let me see. Yeah. Okay, so we're gonna have to use 295, okay? And let me tell you why this is gonna be okay. Okay, even though you will see I'm gonna have to do some special adjustments here because we got 295 and 290. Okay, of course, if I do 295, really, my real bet, okay, it's that UFO. See, that's what's super interesting of dealing with the options, isn't it? That, you know, even though we have the rules, on top of the rules, there is something that we need to use, which is common sense, because sometimes you want to apply a certain rule, but you cannot because you don't have the strike you need, okay? And you still need to put the trade in place as long as it makes sense. And for you to know if it makes sense, you need to use common sense, okay? Which sometimes is common, sometimes is not. So we need to really, especially, keep emotions under control here, because if not, we can get ourselves in trouble. Okay, so now let's take a look at what we have here, because this is a very unique situation. Okay, and this is gonna be a little advanced as a conversation, so hopefully you guys follow. If I go too fast, please let me know. I know not everybody in the group trades options. Okay, so you guys please lead me if I go too fast. And I mean, the video will be recorded. You can always rewatch, but you know, the idea is to execute those trades in the session. So ideally, you would want to follow me all the way. So please comment on the chat box if it's not the case. So now, what do we have here? Again, the statistics suggested, okay, that from now until interesting. Okay, now from now until August 30, the statistics suggested that this market would fall no below 308. So you know, that's why I'm feeling comfortable using 295. Okay, and by the way, not only because of that, also because I have UFOs to lean against. Okay, I have something to defend myself with. It's not only a mathematical calculation. I actually have on-field orders in the market. Is that making sense? So it's critical that you remember that. Okay, absolutely critical that you remember that. Okay, so now 295 is fine because of what I just said. You have the UFOs and the stats in your favor, but because we don't have 292.5, the risk I am assuming here is $5. I'm assuming $5 of risk. Okay, $5 of risk. So, you know, on the upper part, I am not assuming $5 of risk. I am assuming $2.5 of risk. So I'm gonna have to play with certain adjustments to make this trade, you know, the greatest as possible. Okay, and this trade will automatically become a higher risk trade just because you got $5 difference between strikes. So out of the bet, you know that your risk is gonna be around $500 per contract, and unless your account is of a certain size, then probably this trade would not be able to be executed unless you are okay assuming at least $500 of risk per contract. So ideally, I would have loved that we had the 292.5, because then I could have got $2.5 of risk, which is $250, but we cannot because we don't. Okay, again, going back to the option chain, in case I explained this too quickly. So you got 290 and 295, and there is no 292.5 in between. It does not exist. This option has not been listed. Okay, and therefore you cannot trade it. You can call your broker and require the option to be listed, but normally it would take a long time, and probably you will not be able to execute today. Okay, so you know, normally it's not worth it to kind of waste your time requiring new options to be listed. Okay, so anyway, so what are we gonna do? Well, on the upper part, we do have 377.5. Right? So since we do have 377.5 on the upper part, to equalize the $5 risk, okay, I'm just gonna add $2.5 extra to make the upper part just like the bottom part to be $5 of risk. And with this, okay, I'm going to come back here now, and readjust the trade accordingly, looking for 290 and 295, and then on the upper part 377.5, okay, and 372.5. Okay, I have it. Okay, now if you do this trade, okay, midpoint, you get paid 47. Okay, what are the rules? The rules tell us that we want to take at least 15% of the risk. So it's not looking too good. Why? Because the risk is 5. Okay, it's the distance between strikes. And 15% of 5 is how much? 75 cents. But how much is looking like I'm gonna get? I'm gonna get 48. Okay? So that's a problem. We are not meeting the rule, and therefore this trade cannot be executed. So what can we do? Well, knowing that our bottom UFO is 302 and our top is 373, what I could try to do is go for the next expiration date, 358, 304. This is still valid. And if I was to do that, I still have 5 of risk. Now I get 66, which is better than 40 something. So I still have the same UFOs. I still have statistics that fall between my UFOs. Still good. Now I get more premium, but I'm still not getting the 75 I need, which is 15% of 5. So not good. Now, you could argue that maybe if you place another at 75, you may get filled, because really the spread is quite wide from 28 to 110. So you may get filled, okay? But precisely because the spread is so wide, I'm really not too comfortable. So ideally, the option that will give you narrower spreads is the option that is the one in September 20. Because, you know, when you move out in time, the further out you go, you lose liquidity, and therefore you normally find liquidity again when you find those monthly expiration options, in this case, September 20, okay? But I'm not gonna be a fan of doing this, because 43 days to expiration, that's gonna make the time decay to be quite slow. And now you're exposing yourself to the market to become very trendy. Remember, stocks are fragile. If the S&P starts pushing in one direction, no matter if it's up or down, then you know you are likely to surpass your UFOs because it's 43 days for you to expect that stock to not to move too much, right? And you know, the longer you expect the stock to not to move too much, the less probable this will be. On top of that, you have a slower time decay. Okay, so it was looking good, guys. At some point, it was really looking like we may get a trade, but we didn't. Okay, so I'm gonna have to go back to Merck. So with Merck, that was the other opportunity. Now for Merck, I'm gonna have to first disconnect myself from oh yes, I need to activate it here. So I need to disconnect myself from the network. Actually, here's what I'm gonna do. I'm gonna deactivate AutoUFOs, because remember, with Merck, I need to load data all the way to October 1st, 2000 in the 55-minute time frame. Okay, so I want to do that. Okay, I want to do that. I am actually doing it. The data has been downloaded. If I go to the beginning part of the chart, this is October 2000, as you can see. Okay, so we have all the data. But important, notice I have disabled AutoUFOs before I loaded the data, because it would probably freeze your computer with so many bars. Because remember, TradeStation has you know, a way on how to process information based on 32-bit architecture, and that may be too much. Okay, so what do you need to do? Disable AutoUFOs. And now what am I going to do? I'm going to go to platform toolbars. I'm going to activate the status bar, just so I get to see my blue button, SIM. So I double click, so I disconnect myself from the network. Notice that data is red, SIM is red. Because I disconnected myself from the network, I don't have ticks entering, and therefore when I activate AutoUFOs, it may take a while because it's a lot of data, but your AutoUFOs will be calculated only once. And here we go. Here is the data I needed to find out. Okay, so the question was, do I have UFOs above price? And the answer is yes. Okay, I have UFOs at 89. I also have UFOs at 90. Okay, Those are the UFOs I care about, because those, if I go back in time, notice I will find those around December or January 201. This is where I'll find them. I got nothing else above that. Is that making sense? So 89 and 90 are relevant figures for Merck. We know that because of market data coming from a very, very old time. But also 54% is the value I get when I apply AutoUFOs to a regular session. I will also want to know what happens with pre and post market. Okay, so if I do that, okay, I got 44. Okay, so 44, it's worse. In other words, for Merck, it is actually better to use a regular session, and therefore we got 2 UFOs to defend ourselves to build a non-directional trade above price, which is great. Okay, so now I got way too much data. If I reconnect now, my trade station may freeze. Okay, so the first thing I'm gonna do is to change to daily and change back to 55. So automatically my trade station go back to the default settings, which is to load 1,597 bars. So I don't see the UFOs anymore because they are too far on the left, but it doesn't matter because I draw my lines, so I know 89 and 90 are the values I'm looking for. Okay, so now I can double click again in data, go ahead and input my password to reload TradeStation, and now I'll be enjoying real-time market data one more time, knowing again that 89 and 90 are relevant values for Merck. Okay, I think this is the first time actually that we need to do something like that, you know, in a session while we are live. Okay, so let me make a little more space vertically on the screen by disabling the status bar. We don't need that. And now I'm going to just go back to putting all the market data in the middle of the screen and continue the process the way I just started. Okay, continue the process the way I started earlier, which is bring the option chain, load Merck. You may remember we said Merck has earnings on August 20. I want to double check that information. I don't want to be overconfident. So actually I was wrong. Yeah, Merck is October 29. So we have nothing in front of us. We can use any expiration date. Of course, using August 16 would be the normal beginning for us to plan the trade. Okay, so if I was to do an iron condor on Merck using August 16, this needs to update. Here we go. So we got 87.5 and we got 82. So 87.6 right now would bring us to the 89 UFO. Okay, and below price we got 80.9, so we got 82. So in other words, I'm gonna ignore this for now. Okay, and one thing that would make a lot of sense is to set up an iron condor, assuming we have premium enough, where you would be, for example, buying the 90 call, selling the 89 call, okay, and then below price, selling the 81 put and buying the 80 put below. Okay, something like that could make sense. But of course, let's take a look at the 89 call to see if we got the premium that we need. That's really the key. And 89 is paying us 3 cents. Okay, so that's not enough using August 16. So we're gonna go ahead and give it a try using August 23. Okay, so the 89 would pay us 18, so that's not enough. August 30 for the 89 would pay us 30. That could be enough. Okay, so if we use August 30, the question is, the stats will not be bringing us to 87.6. Now the stats are bringing us to 89. Okay, now 89 is 89. Okay, so actually we could do the same trade using August 30 expiration date, and it seems that this, based on stats and based on UFOs, it may be valid. So in the upper side we got 89 and 90. On the bottom side we got 80.91, which is also right exactly to, we got 80.92. So really it's pretty tight, okay, but it's certainly meeting the rules, so we are fine, and therefore we're gonna do 80, 81. Okay, 80, 81. Okay, so if we do that, okay, if we do that, what do we have? Okay, Well, if we do that, we have an iron condor that pays us 28, where the risk is 1. The distance between 80 and 81 is 1. The distance between 89 and 90 is 1. So we have the risk of 1. Remember, we want to make at least 15% of 1, which is 15 cents. But, oops, sorry, I just used the wrong drawing tool, guys. But instead of 15 cents, we are being paid 28. In other words, this is a valid trade that meets all the rules and would pay you enough. Okay? So this is a valid trade. So let me write it down. Let me write it down because there is another potential possible combination for us to explore. So option number 1 is to use August 30 using a $1 risk combination. Okay. This would produce a credit of 28 cents. Okay, credit of 28 cents. So that is 28% of the risk. Okay, so that's option number 1. But another option that we can do is to, instead of looking at a $1 risk combination, we could also look at a 0.5 risk combination. This is not always available. This is not always available, but in this case it is. When you look at the option chain, notice how we got 89, 89.5. Okay, we got 81, 80.5. So we got 0.5 strike price increments, which is not available for all stocks, but we do have it available for that particular stock. So the question is, if I was to set up the trade using 89, 89.5, and then I was to use the trade with 81 and 80.5, I would make the risk of the trade to be 0.5, right? 0.5. And if I make the risk 0.5, the question is how much I get paid. Well, I get paid 15 cents. Okay. Well, 15 cents is certainly more. Okay. Let me come here. So if the risk is 0.5 and you want to make 15% of 0.5, that is 7.5 cents. Well, of course, if I make 14 cents is kind of double. So the rules are met, right? Now, the question is, what is better? To make 14 cents with a $0.5 risk, okay, which is 0.14 divided 0.5, that is 28%, right? So what is better? To collect 28% of your risk in premium or collect 28% of your risk in premium? Well, it seems pretty clear. It's the same, right? So which one would you pick? Well, I will go for the one on the top. Okay? Because in the end, if you want the trade to provide X amount of profit, okay? Let's say you want to make, just to use round math, let's say you want to make $280 in the trade, so you will want to use 10 contracts on the upper combination, but you will need to use 20 contracts on the bottom combination. And 20 contracts in an iron condor means 40 contracts, 80 contracts, because it's times 4. So you will need to pay 80 times commissions on the bottom combination, where you would only need to pay 40 times, okay, which is, again, half, because the premium you get paid above is double the premium you get paid below. So everything is times 2 or half, depending on which combination you are referring to. Okay. So in other words, the right combination will be the one that we had here. Okay, using August 30, and this trade is valid, meets the rule, and therefore I'm just gonna place an order. Okay, so I'm just gonna reset this to 81.80, go back to 89.90, and the moment I have all those values right, okay, of course you will need to evaluate how much risk you want to execute in this trade. This trade has a risk of $1, as you know. Actually, it's less. It's $1 minus 28. So the most you can lose is 1, which is 100, minus 28, okay, which is the credit you collect. Right now is 26, so I'll make it 26. So that is $74 of risk per contract. Okay, so let's say your risk management tells you that you are okay risking up to $300 every trade. So $300 divided by 74, which is the risk of this trade. This allows you to take 4 contracts. So what would you do? You would come here and select 1, 2, 3, 4. And now that you got 4, you know the risk of the trade is $300. Okay, and what do? You just come in here, click trade. Okay, and execute this trade using limit price, go for the mid. Okay, in my case, because it's a simulated account, I'll just do market, and that's it. But please don't do that yourself. Okay, just go for the limit price, go for the midpoint, which right now is 26. Okay, so if you are executing this trade and you get filled, just got filled. So if you're executing this trade later on, please go ahead and let me know. So I know. Okay, I love to know. As your guide, you know, it's obviously important for me to know what you're doing, how is it going, etc., etc. Okay, so we have the trade. You can see it here in the managed portion. We have Merck. Okay, you have the 4 legs. So here's the trade. Notice how my starting point is to lose 30. Okay, and the reason why I'm losing 30 is because I got slippage on 4 legs 4 times. That's 16 times slippage. So that's why I said don't use a market order, go for limit so you get a better price, okay? But now, you know, as time passes, I've started making theta, etc., etc., etc. Good. So anyway, so we got this. So time to go for more trades. And now we're going to switch gears to directional trading now that we got this trade in place. Order enter for Lisa. Very good. Love it, love it. Perfect. Okay, so let's move into directional trades. Okay, we got 5 minutes until the session is over, so we got 3 potential opportunities to go long. To go short, we got a few more. Okay, why is that? Well, let's look at the broad markets. So what have been the broad markets doing? Remember, when I'm planning the trades here, I'm planning the trades like you are taking 1 trade at a time, right? But the reality is that is not the case. Okay, the reality is that you guys are running a portfolio based on what we covered in the sharpening sessions. You may need shorts, you may need longs. Everybody in the group may be in a different position situation with different needs. The fact is that since some time ago, the S&P that was moving up quite nicely had a pretty intense push to the downside. And the amount of push that took place is 6% in 12 days. Okay, and this is enough to scare many people, and I'm sure they talk about it on TV. Okay, so because the market is going down aggressively and stocks depend on the market, so we got more short-term opportunities than the longs. Okay, less stocks meet our climate rules because the broad market is pushing hard down. Okay, and that's why if you were long, very good, Bojan. Very good, Brian. So if you were long, okay, you had multiple trades that were short, and you had the gamma in your favor, you had short trades offsetting, hedging long trades, and vice versa, and you are managing a portfolio, okay? So as I plan those trades for long and short, okay, I'll just be, discussing 1 trade at a time like it's a unique trade. But remember, none of those trades are unique. We are treating those trades, like part of the portfolio, and some of those trades you may not need them, so please ignore me. Some of those trades you may need them, so then you can go ahead and execute. Supply and demand trader, good to see you, my friend. Very good job as well with diligence and discipline, you guys getting those trades in, okay? And by the way, if you are not super comfortable with options, I know some of you are in the process of learning, use a paper money account, guys, okay? This is the opportunity for you to practice and get to see how the trades evolve and what happens, and when you lose, what happens, and when you profit, what happens, and get to develop skill and confidence, isn't it, Bojan? We talked about that a few hours ago. So anyway, ACAD, it has an average price around 27. Around 27, we got nothing. At least with regular session data, which provides 52%. If I switch to pre and post market, 52 becomes 45. So we're gonna have to ignore this, okay? And since we got nothing around 27, no need to invest more time analyzing that stock. IEF is an ETF, so I will skip it. NWL, Newell Brands, we load that stock. Not in love with the fact that the stock is so cheap. But you know what, is what it is. That's what the market gives us. So you may have to take a trade with more contracts given the fact that the stock is cheap, okay? So you can have proper exposure. Yeah, absolutely, Brian. So loading the data here, PD on the upper left, so just waiting for the data to be with us. I'll take a quick look at the shorts. What do we have on the shorts? Okay, we have a few important names here. So 48%, that's what we got. If I switch to pre and post market, let's see, we got 49, that's not enough. For directional, we need 50% or more. We are not gonna be bargaining with the statistics when directional. Okay, it's either we got proper stats or we don't execute trades on the stock. So no long opportunities at this moment in time. Of course, you can rerun the scan and new opportunities may have arisen. Okay, so you can certainly do that. But on my case, I will not do it since the session is reaching its ending time. Okay, so what do we have here? So let's focus on the most relevant names. Snap could be good. Tesla, let's take a look at Tesla. So loading Tesla, pending data. I'm just gonna click on Under Armour as well. Okay, so loading data. I'll also click on Snap. Loading data. Yeah. We have Google, Blackstone Group, APC. This normally has good options as well. Fast moving stock, oil based. Okay, so let's begin with APC. So APC is giving us 51% with pre and post market data. With regular data. Pre-post market provides 49. So for that stock, we're gonna be sticking to regular data. So stock is moving down. 72.97 is the rise price for us to short, and this coincides very nicely with this red UFO, where the bottom part of the UFO is 73.07, as you can see, which is certainly close enough to that average pointing at 72.97. Remember, with stocks, we don't need to be precise like what we do with intraday futures or intraday forex. Okay, so that's going to be good enough. Okay, and therefore, since we are in a case with a confirmed climate, I'm going to move the stock to the next common time frame, which is weekly. Activate AutoUFOs to be able to spot what the target would be. And in the case of APC, the target price for us to take profit would be 47.20. Keep that number in mind or make a note or both. So knowing this, I'm going to go back to daily. We are done with that particular chart, and now it's time to plan the trade. A trade where the entry would be triggered when Anadarko Petro reaches this UFO at 73.07. That would be your entry point. Okay, so don't get into this bearish opportunity yet. And then somewhere in here we will want to buy a put. Okay, and somewhere below 47. Okay, we will want to sell a put. Okay, so now this 47, notice the scale. Okay, so 47 is way lower. Exciting. Okay, at the same time, I would say unlikely. Okay, unlikely because depending on the calculation for time to target, and also importantly, depending on the next earning dates for APC, we need to be out. So when is the next earning date for APC? Is October 29. So we got time. We got almost 3 months. So I mean, if there is a major sell-off in the market, guess what? We may get to 47. Okay, but you will need something pretty intense for a $70 stock to drop by $30 or $25. Okay, so that would be quite intense. Okay, we have seen that before. Okay, so let's position ourselves to take advantage of that move. Okay, so first, TTT calculation, time to target. So the entry price would be 73.07. The target we just said is 47.2. Okay, so that is a $25 move, and that stock, it's currently moving at a rate of average true range is 60 cents a day. So $25 divided 0.6036, that is 42 weeks is the expected amount of time to get there. 42 weeks, because this is a daily calculation, I need to multiply times 7 to get the dates, to get the day, and that's 300 days. So in other words, we're talking about a one-year trade, and obviously earnings take place every 3 months. So it's no way we're gonna get to 47. This is a too hopeful trade. Having said that, it's great that we got nothing to stop price from falling all the way to 47, okay? But we also need to be realistic, and because stocks are a unique animal, if you wish, a unique type of market where we have earnings reports, other markets don't have that, then I'm gonna apply AutoUFOs to the daily time frame, which is something that we don't normally do, okay? And when looking at the daily time frame, I'm just gonna be looking at 2 UFOs below. So I will ignore the first UFO, I'll go for the second one, and the second one would be setting the price at 70.28. Okay, so we may have that particular stock stop dropping there. That's one possibility. The other possibility would be to reach that 64.75. Okay, and the next one is going to be that again, around the 47 we found earlier. Okay, so this one again, I need to use a little bit of common sense here. This is where there may be a little subjectivity with we're setting the target, which really is something not too welcome, but at the same time, given the fact that with stocks I got the limitation of the earnings date, I need to apply a little bit of common sense. And if from now until earning I got 3 months, right? I got 3 months, which 3 months is like 90 days, okay? 90 days, it's kind of like, let's call it 3 times less than 300, that's 100 days, right? So, well, if the move we're trying to collect is 25.8, but I got 3 times less time, so that will bring the expected move in 90 days to be around $8.6. So $8.6, if I drop this from 73.07, that was the entry, that brings me down to like 64. So 64 something, I guess you are with me, that now it makes a little more sense and is less subjective now if I use 64.75 as the target, okay, given the amount of time I have to be in the trade, and given the fact that because stocks are unique, because they report earnings and I need to be out before the next earnings report. So I believe that I am making sense by deciding the target to be located at 64.75. So that's where we are going, okay? So we're gonna have to use expiration date for APC. Okay, expiration date. We're gonna be looking at next earnings, which is October. We don't have October, so we're gonna have to use November, okay? But even though we use November, the moment you reach October 29, you need to be out before that. And by the way, October 29 is what it shows now, but as the earning days approaches, this date may change to October 27, October 25, or November 2nd. You never know. So you need to be watching this as the date approaches. So we're gonna be using November 15. That's the earning days we're going to be using, and we're going to be building a vertical spread. Okay, so analyze by vertical spread using those puts. Okay, so my concern when planning this trade is what my Greeks will be at entry, which is 73.07. Being my target 64.72, I want to sell puts, that are below 64.72. Let me do this so I have more strikes available. So what do I have? I have 65. Well, 65 is above 64.75, which is my target. So I'm gonna have to use at least 62.5. Okay, 62.5. How much I get paid for the 62.5? I get paid 7 cents, 4 cents. It's very little. And to be honest, I will get paid even less if I analyze by a single. So let me uncheck the vertical. I only look at the single 62.5. Okay, this option will have a value of $2 once the stock goes back up to 73.7. So even though normally we do spreads, given the size of the move to be collected on APC, where we have a lot of room for this to fall, okay, given that fact, okay, it makes no sense to sell the 62.5 put, which is the one you need based on your target, because this put is gonna only pay you $2, and that put is gonna cap your profit. So it's worth it to not to use it, okay? And if, let's say, and this again, what I'm gonna talk about is just a possibility, not a reality, but let's say APC was to start moving your way, and something crazy happened to this company, and next thing you know, you have a 30% gap down, right? If you did 75.62, well, it doesn't matter if it drops below 62, it doesn't matter if it drops all the way to 10, you are out of the trade at 62 because the 62.5 put is capping your profit, which again is fine, you make what you wanted, but given the fact that capping your profit will only give you an advantage of $2 extra, it makes no sense to cap your profit, and therefore what I'm going to suggest is to go ahead and simply buy one put that gives you around 35 delta, okay, and I would say 72.5 is probably a valid one for you to use. So you're gonna buy the 72.5 put, okay, we are just gonna go with one put, we will not do a bear put spread in this case because of what I just explained, and if it doesn't go your way, well, this trade is risking $117 of your account. The most you can lose is 170, actually less. When you get to the entry point, okay, sorry guys, I'm having a problem with the pointer. I used to do the drawing on the screen, or for whatever reason I cannot do the drawing on the screen. It's okay. So if the moment you get to 73.07, this trade will cost you, this put will cost you like $78, and therefore the most you can lose is going to be like $78. Let's call it 80. Okay, and if APC falls, the more it falls, the more you profit. And when it gets to 64.75, then you would close the trade for a nice profit. If you're curious to know how much your profit would be when you get to 64.75, you can have an estimation of that, and you can see your profit is going to be around 656 plus 40 is kind of like $700. So you're risking $80 on the trade, and if you're right, you'll make 700. Okay, so it's like a 8 or 9 to 1, something like that, if I did the math correctly. Okay, so pretty nice, pretty powerful trade. And again, now maybe I'm being a little too optimistic, but if something dramatic was to happen to that stock and gap down 30%, again, you don't have a short put that caps your profit, which I would prefer to be honest, okay, because it reduces the risk of the trade, but in this case, it only reduces the risk of the trade by $2, so it's not worth it, okay? So hopefully all of these makes sense, and you got my point, and therefore, we're gonna be using the 15th of November, okay? So we're gonna use 15 November 2019, and we're gonna be buying the 72.5 put, okay? And we will not be selling the put below. That's the trade. That's it. That's that simple, okay? So placing the order, I'll place the order and we'll conclude the session for today. Click on trade. Okay, here's my trade. I will want to buy, as you can see, buy to open the 72.5 put that expires in November. All of this is good, but I need, very important, to activate a rule based on the price of APC. Click on add, and when APC reaches that 73.07 mark, then I will want TradeStation to then activate the order, not now, then activate the order and buy me that put. Okay, so I'm gonna click place order. I got my confirmation window, buy the 72.5 put, only if APC reaches 73.07 or above. Yes or no, I'll say yes, 1, 2, 3, the order is in, that's it, okay? Cool. Yep, so we have it. Okay, my friends, we have the trade, we have the plan, we have the session for today. Guys, I missed you. The last time we conducted the session was last Thursday. It's been a week. Putting on the side that I had a little bit of interaction with you last evening, US time, earlier this morning, Asia time, when Bojan was conducting the amazing psychology sessions that he did, which again, if you didn't hear me say it before, make sure you watch that session. It's on the YouTube channel. I can show you that if you wish. And I was missing you guys. So, but again, good news. We are back tomorrow for short-term trading. So if you are not aware of that, tomorrow we will be back with short-term trading. Let me show you in the playlist. So playlist, we have get together. Okay, get together. Here's the one, special trading psychology. Here's the session I'm talking about. Okay, very, very, very super powerful session, guys. Okay, don't miss it. Okay, and yeah, and as I was saying, tomorrow we are back for short-term trading, and then over the weekend on Sunday we will be getting together for sharpening. Okay, so this week it's a little intense. Okay, we have 4 get-together sessions this week, if you count them all. And by the way, the sharpening session over this weekend, I need you all to be with me live. Of course, you know that we record the sessions, but it will be important to be live to ask questions, because we're going to be going over, instead of looking at the market climate the way we have been doing up to 9, which is perfectly fine. And to be honest, we don't need to do much more, but we'll do a little more. Okay, so instead of using DMI, we're going to be using AutoClimate, okay, which is a new app available, and I need to teach you how to use AutoClimate. And this is going to be really powerful, adding more odds to understanding how it will work. Okay, David, hi. I even made my bed this morning. Love it, love it, love it, love it. Okay, yeah. Well, if you are wondering what does that mean, okay, then you need to watch Bojan's session and you will understand. Yeah, wonderful. Okay, everybody. So hey, see you tomorrow. See you on Sunday. Love it, love it. Yeah, let's keep going tomorrow, and you guys keep up the good work as you always do. Okay, see you tomorrow. Bye bye, everyone.